What are the tax incentives for startups in Singapore? Singapore offers a range of tax incentives to encourage entrepreneurship and innovation, particularly for startups in their early stages of development. Here are some of the tax incentives that startups in Singapore may be eligible for. Number 1. Startup Tax Exemption Scheme, or SUTE. This scheme is available to companies that are incorporated in Singapore and have no more than 20 individual shareholders. Under this scheme, eligible companies can claim a tax exemption on the first 100,000 Sing dollars of normal chargeable income for each of their first 3 consecutive years of assessment. Number 2. Partial tax exemption. Companies that do not qualify for the SUTE can still claim a partial tax exemption on their taxable income. Under this scheme, eligible companies can claim a tax exemption on 75% of the first 100,000 Sing dollars of normal chargeable income and 50% of the next 100,000 Sing dollars of normal chargeable income. Number 3. Tax incentive for angel investors, or AIS. This scheme is designed to encourage investments in early stage startups by providing tax incentives to angel investors. Under this scheme, investors who invest at least 100,000 Sing dollars in qualifying startups can claim a tax deduction of 50% of their investment amount for the first 2 years. Number 4. Early Stage Venture Fund Scheme. This scheme is designed to encourage investments in early stage technology startups by providing tax incentives to venture capital firms. Under this scheme, qualifying venture capital firms can enjoy tax exemptions on income derived from their investments in qualifying startups. These are just a few of the tax incentives available to startups in Singapore. It's worth noting that eligibility criteria, application procedures, and other details may vary depending on the specific scheme. In this video, we will look at the criteria required to be eligible for the Startup Tax Exemption Scheme. The first criteria is the company must be incorporated as a private limited company in Singapore. Secondly, the company must be a tax resident in Singapore for the year of assessment in which the tax exemption is claimed. A company is considered a tax resident if the control and management of its business is exercised in Singapore. Thirdly, the company must have no more than 20 individual shareholders throughout the basis period for the year of assessment in which the tax exemption is claimed. Shareholders who are corporations, however, are not counted towards this limit. Number 4. All individual shareholders of the company must be individuals who are not carrying on a trade or business, or individuals who are holding shares as investment. Lastly, the company must be a Singapore tax resident company and its annual revenue for the financial year must not exceed 5 million Sing dollars. Under the SUTE scheme, eligible companies can claim a tax exemption on the first 100,000 Sing dollars of normal chargeable income for each of their first 3 consecutive years of assessment. For further details and clarifications, do reach out to us today to take advantage of these incentives, and I will see you in the next video.